we might have reached the end game of Federal Reserve easing. And this chart, what you can see, you can't see, but what's really happened is we have the recent example of way too much liquidity, pumping too much money in the system, and the excess inflation that came out of that from COVID. Now, somewhat of that is not just from pumping too much liquidity, but that's basically what happened. So now we have the lesson of, okay, when the stock market starts rolling over, can we just throw money at it like we did last time to keep it elevated? And the risks are we've reached the end game. And to me, that's what gold's telling us. Things like very elevated in say almost 18 million cryptocurrencies, excess of supply, a lot of hubris in that space. They're telling me that
Yeah.
we've probably reached the end game of massive wealth creation in the U.S. And to me, that's part of what gold's picking up.
The S&P 500, which had plunged earlier this year following President Trump's announcement of Liberation Day tariffs in April, has since staged a strong rebound. It rose 6.2% in May, its best performance for that month since 1990, and climbed another 4.6% in June, hitting new record highs. Mike McGlone, senior commodity strategist at Bloomberg Intelligence, acknowledges the current resilience of the stock market, but warns that stability is key. If equities begin to weaken meaningfully, it could signal the onset of a broader deflationary cycle. Historically, deflationary environments have been favorable for gold, as investors seek safety in hard assets. Inflation data continues to hover near the Federal Reserve's target. The Personal Consumption Expenditures Price Index, the Fed's preferred measure, rose 2.3% in May, slightly above the 2% goal. Meanwhile, the Consumer Price Index rose 2.4% year over year, cooler than many economists had anticipated. This suggests that inflation may be easing, but not enough to encourage aggressive rate cuts in the current geopolitical and fiscal climate. McGlone believes we may be approaching the endgame of the recent era of wealth creation, fueled by accommodative monetary policy. With inflationary pressures still present and the Federal Reserve constrained in its ability to ease further, partly due to Trump's expanded tariff measures, gold is increasingly being seen as a strategic hedge. Federal Reserve Chair Jerome Powell acknowledged that the central bank likely would have cut rates further this year were it not for Trump's aggressive tariff policy. McGlone also draws attention to the Dow to gold ratio, which he says mirrors the setup seen in 1971, the year the U.S. severed the dollar's link to gold. At that time, the shift triggered a prolonged period of gold outperformance. In 2024, the Dow to gold ratio has climbed to around 19, well above its historical mean of 9.7 and median of 5.5. If this ratio were to revert toward or below historical norms, it would indicate a significant trend reversal, with gold significantly outperforming the stock market. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Basically, gold at the end of last year was relatively expensive versus everything, most notably other commodities, um, um, silver and things, but it's very cheap versus one key thing, the S&P 500, U.S. stock market. So it's starting to recover. S&P 500 is about 5%, up about 5% this year. Gold's up 25%. To me, that's part of that reversion of the per ounces of gold going back to about a 1-to-1 historical ratio with the S&P 500. Right now, S&P 500 is just above 6,000 and gold's running 3,300. So it's a matter of time. I think it gets back there, and just do we have that catalyst to do that? Looks like it's kicking in. But to me, this is more a normal cycle of deflation that follows inflation. And by deflation, it means something that goes up too high goes down. And the number one major final asset in the planet that's way overinflated by some measures is the U.S. stock market. So a good simple thing I just will be publishing them by the time we put this out on July 1st, this is June 30th, is you look at the earnings yield, the one-year earnings yield on the S&P 500, it is about almost 50 basis points negative to 10-year note yield. That's the lowest since 2002. So it's just an example of how high, how elevated the stock market is, how low the earnings are, and what's your alternative? You get risk-free treasuries at right now 4.25, and that 10-year note, that long bond peaked around 5%. It looks like those are tilting towards deflationary forces, and to me, the key thing that's stopping it is a stalwart U.S. stock market, which means the risk is it's got to stay strong, or we tilt over toward a normal deflationary cycle. That rollover you see there is very similar to what happened in 1971 when President Nixon ended the U.S. gold standard, and it looks like it's rolling over now. It's bounced, but right there, a little bit for yeah, right there. See how it rolled over? That's
Yeah.
what I think we're doing now. But it's not going to be easy. There'll be bounces. So to me, that's what's happening. It's just going to go back towards who knows whatever the mean is. We'll start with 10 on this chart. Um, and
Sure.
there you go. There you go. So that's one of the key things I've been looking for. It's just been taking a little while to do it. It can't be easy. Remember, what do we have, like a 100-year chart here? So the day trade
Yeah.
doesn't matter. Right now, U.S. stock market cap to GDP is 2.1 times. It's the highest since 1929 or so. The U.S. stock market cap to the rest of the world's GDP, the rest of the world's stock market caps. It just recently was a few months ago at the end of last year, the highest in our database going back 56 years. That's what's changed. Right now, the market's much more financialized. But the bottom line is it different this time? And to me, this is what gold's sniffing out, is that the U.S. stock market's extremely elevated. And we probably, what's one thing that's different is we might have reached the end game of Federal Reserve easing. And this chart, what you can see, you can't see, but what's really happened is we have the recent example of way too much liquidity, pumping too much money in the system, and the excess inflation that came out of that from COVID. Now, somewhat of that is not just from pumping too much liquidity, but that's basically what happened. So now we have the lesson of, okay, when the stock market starts rolling over, can we just throw money at it like we did last time to keep it elevated? And the risks are we've reached the end game. And to me, that's what gold's telling us. Things like very elevated in say almost 18 million cryptocurrencies, excess of supply, a lot of hubris in that space. They're telling me that
Yeah.
we've probably reached the end game of massive wealth creation in the U.S. And to me, that's part of what gold's picking out. That's part of the thing. The way we started last year was you looked at the S&P 500 divided by the Bloomberg Commodity Spot Index that reached the lowest level in about 25 years. So there's a lot of room for reversion. But what's the oomph for commodities to go higher? You have to start with crude oil. When we see they're oversupplied, it's not working. Okay,
Yeah.
well, gold's the only one that's really holding the Bloomberg Commodity Index up. Now, a little bit industrial metals, but they're distorted by tariffs and coppers. So the bottom line is the key theme out of that is it just shows how expensive the stock market is, not just versus gold, not just versus commodities, not just versus GDP, not just versus earnings, and the rest of the world's stock market caps. You can just see that's probably a sign that that's where the sore thumb is, and you just have to look for catalyst for reversion. And so far, we've only had a little tweak this year. We've had a quick V bottom, and this recovery has been one of the fastest in history from such a bottom, which typically can happen. Maybe we're making a double top. I don't know, but it's just not a level I think you'd be overweight risk assets when they're this expensive versus some other more traditional assets. Like I showed you gold earlier, and you just mentioned the one from S&P 500 for the broad commodity index.
Mike McGlone notes that while some recent economic data appears positive on the surface, it may reduce the likelihood of a Federal Reserve rate cut in the near term. He argues that the main factor capable of shifting this outlook would be a notable decline in the U.S. stock market. As long as equities remain elevated, inflationary pressures are likely to persist, diminishing the Fed's incentive to ease monetary policy. Federal Reserve Chair Jerome Powell's recent comments support this cautious stance. Despite mounting political pressure from the White House, the Fed has entered a holding pattern on interest rates. At its most recent meeting, the central bank kept the benchmark federal funds rate unchanged in the range of 4.25% to 4.5%, a level it has maintained since December. According to the Fed's latest dot plot, members still project the possibility of 2 rate cuts by the end of 2025. However, Powell emphasized that the central bank is in no rush, stating that it is well positioned to adopt a wait-and-see approach. Let's get back to the interview.
I think the stock market is anticipating the bill from this great big bill to make a big difference with earnings and markets, and anticipating Federal Reserve easing. But it could be potentially a bit irrational and delusional at this point because by the stock market going up, making record highs, and things like Bitcoin going up, making record highs, it's increasing that inflation pressure on and the Fed, and it's just silly to think that the Fed would be easing in this environment because typically that's where they hike rates. It's just not usually how it works. But markets front running, I think it's in its stage now that it's never going to go down until it starts going down because there's so much buy the dip momentum going on. But everything, as you pointed out, I mentioned earlier, is actually starting to tilt lower. Um, for instance, we expect our Estelle, who's our economist, who's filling Anna Wong for Anna Wong this morning. Our morning meeting
Uh-huh.
expects it. Then the employment rate to pick up to 4.3% on Thursday. Expects non-farm payrolls to be a bit weak. She sees gains in leisure and hospitality slowing down. Gina Martin Adams, our equity strategist, sees that the Fed, the market actually is depending on Fed easing. This complete concentrated returns, the S&P 500, the top 52 stocks are accounting for over like 99% or so total returns. And there's alternatives outside the U.S. For instance, growth in techs outside of the U.S. is much better. So I look at it as this is part of a bit of end of the summertime, end of the first half rally, and the risks are that we go back lower. I look at more of we're entering some of a lose-lose now. Stock market going up means inflation stays sticky. The wealth effect is extreme in terms of GDP. It's the highest in 100 years. And there's no reason for the Fed to ease an environment, yet tariffs are going to start hitting earnings, and that's already a factor. So right now it's great, it's wonderful, but part of where you see that is in gold. Gold's up 25% in the year. It's doing quite well, and I think that's a key indication that the rock beating stocks is potentially going to accelerate into year end. The Fed, these numbers are expected to increase into year end. Now we've had some good numbers lately, but that's not a good sign for cutting rates. And to me, the key thing, the number one pressure factor to make these levels, which are still up, remember we kicked in that money supply from 2020, still inching higher, just not at the higher rate, is the number one factor for them to revert lower is the U.S. stock market going down a little bit. So it has to stay elevated. And that, to me, is kind of the key thing that's happening in the markets. Overall, this is wonderful. It's a great environment, but I'm worried about the key thing, like I wrote for my outlook for gold for this year's the range between 3,000 and 3,500. I brought it back to gold because to me, it's a good leading economic indicator, meaning if we're above 3,500 by the end of the year, which is kind of my base case, that's not a good sign for what you pointed out for stock market and everything. And it's more deflationary because I think that's the greater risk, things you see in China with that yield at 1.65%. If we can get gold back down towards 3,000, that would probably be a good sign the stock market's doing fine. Rates are higher and everything's doing fine in this country. And to me, that's part of where we are. And it's still elevated. Gold's still elevated. And key thing that's happening so far since the last time we spoke is we've had that big spike in crude oil. It's starting to roll over. This is the situation that's in China right now, 1.65% in the 10-year yield. Most of the rest of the world facing severe pressure on their economies by curtailing exports to the U.S.
Uh-huh.
Top three economies in the world outside the U.S., China, Japan, and Germany, their average yield in their 10-year notes are below 2%. It's not a good sign for inflation, sign of deflationary forces. But to me, that's what's happening. And the key way to watch that is watching the number one commodity in the planet, crude oil. Crude oil's down about 10% in the year. It just had a spike to near 80 because of potential for war and supply disruption risks. And now it's starting to tilt lower, back to $65 a barrel. I think it goes to 40. It's not profound to say that since it peaked at $147 a barrel in 2008, every low has been around 40 or lower. What changes that? We have declining demand out of China, increasing supply in the U.S. and Canada, which is a pressure factor. So there's a number one commodity, somewhat deflationary force. For gold to go up on inflation to me, this is more what typically happens. Gold will go up on inflation or go up on deflation. In an environment in between, it doesn't really do much. And to me, this is more deflationary environment, which is normal after inflation.
Momentum in equity markets might still be grabbing headlines, but deeper signals are beginning to flash amber. Beneath the surface of record highs and resilient data lies a tightening policy backdrop, one increasingly constrained by geopolitics and structural imbalances. As central banks balance inflation control with fiscal pressures, hard assets like gold may quietly reclaim their traditional role as portfolio stabilizers. The shifting Dow to gold ratio, echoing historic precedents, could mark the beginning of a long overdue recalibration. Is the calm in equities merely the eye of the storm before capital flows rotate decisively towards safer, time-tested stores of value? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.